Welcome in. We have a very special interview today with Danielle DiMartino Booth. She is the CEO and Chief Strategist at QI Research. She spent 9 years at the Federal Reserve in Dallas. You guys have seen her everywhere. YouTube, Bloomberg, Fox Business, CNBC. She goes on all of the big shows. She is an incredible mind. For those of you that have not had the opportunity to do so yet, please read her book, Fed Up, an insider's take on why the Federal Reserve is bad for America. She has some very, very interesting opinions after spending time within the Federal Reserve. Follow her on Substack at dmartinobooth.substack.com and quillintelligence.com. So today, we spoke with her about the Federal Reserve, everything that's going on in the economy, the banking system. I hope you guys enjoy. Okay, so the first thing that I wanted to hit on was this 2% target inflation that the Fed keeps going for. I've been saying for the longest time, where did this number come from? That's not the historical average, and we've printed all this money. Where did that number come from? Is it achievable?
So the long story short is it was not achievable. It was not achievable from January 2012 when, in a highly controversial move, Ben Bernanke basically defied the legacy of Alan Greenspan, who always said the ideal inflation level for businesses and U.S. households should be 0%. That was always his philosophy. It's one of the few things I truly agreed with Alan Greenspan about. But the minute, he was like, don't let the door hit you on your way out. The minute he was out, Ben Bernanke and Janet Yellen convened and finally got this, oh my gosh, let me have this 2% inflation target. Why? Why did they want this 2% inflation target so badly? Well, they were starting to get the inklings of the fact that it was very hard to hit 2%. And when it's difficult to attain something, that means that you can, kind of like a dog chasing a car that he will never catch.
You're never going to catch it, yeah.
It's easy enough to say, you know what, we're gonna keep going here, whatever it takes to get to this 2% target. So from January 2012 until when the pandemic hit. Okay, so that's like what?
8 years.
Eight years. Okay, a little bit. 8 years and a month. There were 11 separate months. 11 separate months that Ben Bernanke theoretically succeeded in hitting this target. So a little bit of background here, because you asked a really important question. So you asked a big question too, though. So when Stanley Fischer was brought into the Fed, he was considered to be the godfather of central banking. He had been the central bank governor of Israel. When he was brought in after Janet Yellen had been appointed as head of the Fed, it was covertly to make sure that if the financial system blew up on her watch, there would be somebody there who understood the financial system, which brought him out of retirement. Stanley Fischer's very first Federal Open Market Committee meeting, he raised his hand and he said, I have a simple question. You have this 2% inflation target. Why is the 2% inflation target not assigned to the headline consumer price index that we all live and breathe? That is what we experience. We don't experience some convoluted core measure. We especially experience gas pump prices and what it costs for a loaf of bread and a gallon of milk. And some tentative Fed staffer in the back of the room in the Eccles building in Washington, D.C. raised their hand and said, well, sir, if we used headline CPI, all of our models would break. Now, the models at the time dictated lower for longer. That was the only goal. The only goal after Greenspan got to office was to keeping the federal funds rate lower for longer. Financial repression. Now, if you were to be honest about it, then the Fed would have had to have pulled the plug on quantitative easing. How many times? We don't know.
Yeah, right.
But the whole point of an artificially low inflation target, a core, is that it gave them cover to continue to run unconventional monetary policy for years. Now, why is that? Why couldn't they hit the target at the core? Again, minus food and energy. Well, it's the old adage, you can take a horse to water. You can't make the horse drink. As long as the Fed continued to repress the price of credit using the banking system as an intermediary, that intermediary could act as an obstacle. And it did. for years and years and years. It refused to give access to credit just because credit was cheap. Then comes the pandemic. Well, before the pandemic, the Fed's like, well, we can't hit this 2% target, so we're going to raise the bar a little bit. We're going to have an average inflation regime, which was the stupidest thing anybody ever came up with, because they never anticipated bypassing the obstacle. What happens if you are 4'10" and you could never get over a wall in an obstacle course, and all of a sudden the wall is removed? Well, you just breeze your way right through that obstacle course, don't you?
Right.
Move the banking system as intermediary. That's the construct of post-COVID stimulus. It took federal stimulus, monetized by the Fed. One had to have the other. True complicity in a mechanical way. You're like, I did not mean to ask her a 10-minute question. Truly bypassing the banking system. You are not arbiters of credit anymore. You're simply handing out candy because you're directly depositing money into individual U.S. household checking accounts.
Right.
What do they do now that there's not some mean banker denying them all the credit in the world? They take the money. They spend the money.
Right.
They ignite inflation that pushes 10% because there wasn't one fiscal stimulus program. There wasn't 19 months of a federal rental moratorium. There wasn't a pause for almost 4 years on student loan repayments. There wasn't, in some cases, your medical health care being covered. There wasn't supplemental unemployment benefits that paid you $2,500 a month on top of what the states paid you. All of this money was flowing and flowing and flowing directly into the hands of households with the greatest propensity to spend it. Without the banking system as an intermediary, we got the mother of all inflations. And the Fed did not abandon its construct of average inflation targeting until it was way too late. It sat there and said, this is transitory, it too shall pass. Well, it has to a large extent. The fiscal stimulus has come off its rapid boil. We can get to where it's still very much alive and well, and why the U.S. economy is not in recession, because part of COVID stimulus is still very much in the system, pumping into the system at record levels. But that's for wealthy individuals. For your average schmo, that stimulus spigot has largely been turned off, with the final blow being on average $200 per U.S. household per month decrease in the SNAP program, in the food stamp program a few months ago, in addition to Medicaid rolls being depleted. So now we're seeing inflation come down quickly, which Jay Powell knows. So
just to clarify for our viewers, the 2% inflation target is the PCE target, correct? It's
core PCE. Yes.
Okay, so everybody's got to remember. So that's something that I want everybody to remember, because historical overall CPI is about 3.5% if you go back 100 years. So when we hear 2% and we compare it to 3.5 historically, everybody's got to remember it excludes food and energy, which are highly volatile costs in the economy.
They are, but correct. But much more importantly, housing as an input to the CPI equation is nearly double that of where it is in PCE. So households' biggest line item is underweighted in the PCE compared to the CPI. Of course, it's going to understate inflation. You're not counting as much as you should your biggest bill every month.
So I want everybody to remember, who's watching, you still need to focus on your CPI. You need to focus on the long-term trend of CPI if you're worried about your costs. Don't worry about the month-to-month as much, because if we've seen energy prices have had very high, we've seen 20% changes in month-to-month on energy costs and food costs and things like that. So when you hear Jay Powell come out and say, well, PCE is still pretty good, but if you have a big jump in oil prices, all of a sudden at the pump, you're feeling it a lot different than they are. Remember the whole eggs thing a few years ago when, eggs were up 600% at one point. It was an insane amount of cost. So I wanted to clarify for everybody because, listen, I don't think, and I'm not trying to I'm not a big fan of having a Federal Reserve. I'm still on the fence about it, but I do think Jay Powell has done the unpopular thing, getting attacked on the Senate and the House.
by increasing rates and being able to say, listen, inflation hurts families more than losing 2 million jobs would hurt the 2 million people. I do give him credit for that. It's a very, very tough thing to say. It's not Paul Volcker style tough, but it's still a very tough thing to say in this day and age with social media and immediate news to come out and say, yeah, you might lose your job and I'm sorry, but it's way better than having 100 million families feel higher inflation. Do you agree with that, or am I just trying to defend Uncle Jerome?
No. I have been his number one advocate after having been, his number one detractor for many years. I was certainly not impressed with how he behaved after the pandemic hit. And when he first came out of the gate in 2018, he was kind of the person he is today. But then he took it all back when he pivoted, and it just kind of destroyed my perception of him. But you're right. He really is sticking to his guns on behalf of long-suffering U.S. households. But to me, at least, the reason is more in depth in that for years, ever since Alan Greenspan took office, Wall Street has been in the driver's seat, effectively making monetary policy for themselves. And that's why we see a widening in the inequality gap. And if you have a 2% arbitrary target that allows you to print money in the background forever and ever and ever, despite the widening inequality divide, all that 2% target ever did was keep the Fed running in the background on behalf of the wealthiest so that they could keep their financialization happy machine going and continue printing money for themselves. Mm-hmm. And if Jay Powell sticks to his guns and forces refinancing in a normalized interest rate environment that a lot of these people have not seen in their entire careers, well, then if you start to see the rich get a little less rich, then you breach the idea of beginning to close this inequality gap. And that's even more important than fighting the inflation fight, because for the long-term prosperity, living the American dream, being able to pull yourself up by your bootstraps and be anything, as opposed to what Wall Street dictates you can be because they put a ceiling on you and says stay down, that's a great achievement. If he succeeds, they'll change the name of the Eccles building to the Powell building.
So with regards to the labor market, we're still at record low unemployment rates. Mm-hmm. And Powell has said we need to lose 2 million jobs to get things going in the direction that he wants. What's it going to take? I mean, we sit here and we make videos every day and we're saying, how is this not breaking? How is nothing breaking yet?
And, at the end of the day, low unemployment is an inflationary matter, and we talk about this. And if he really, and I know, my personal opinion, I'm not saying I know, he's probably looking at that unemployment rate saying, mother F, like what is going on? I mean, it's just, we have several businesses upstairs, and we just know with low unemployment, we just got to pay more money to get better people. Because at these levels of employment, to be blunt, you're hiring the unemployable. Sometimes in the cycle, you have to hire people that aren't necessarily worthy of the job because you need to get people in the door and take a risk, and hopefully it works out for you.
Well, I think that those pressures are definitely being alleviated. You're seeing a steady decline in the quits rate. And I call it the take this job and shove it factor. Okay. And that's going to be really beneficial. And it kind of makes sense, right? Because in September of 2022, there wasn't a single U.S. state with rising U.S. continuing jobless claims. Not a single state. Last September, not too long ago. Mm-hmm. Now there are 46 states with rising jobless claims. That encompasses 93% of the U.S. population. For heaven's sake, Hawaii just flipped last week. So you've really only got, in terms of states that have not had continuing jobless claims increasing since September of 22, you've got Oklahoma and Kansas, and that's it. Every other state has seen weakening in their labor market, and it's just a slow bleed because so much of it was concentrated initially in Silicon Valley. It was kind of this white-collar recession with people who had enough of a nest egg that, so what if I lost my $300,000 a year job at Google? Big whoop-de-doo. Mm-hmm. But lo and behold, now we have California jobless claims running north of the national average. And that's just a fact. But when California flipped, the whole country flipped to being year over year positive, not a good thing, in terms of rising, continuing jobless claims.
Can I ask a ridiculous question?
Sure.
You always do.
I'm going to go extreme. Why do we need a Fed? I mean, besides the idea of them setting an interest rate, I would prefer it to be just banks, and Mo will get into that soon, but okay, I'm a bank. I want to be competitive. I'm going to charge a lower rate. And of course, I need to borrow the money from someplace. But why do we need the Fed being such a vocal, especially considering of how publicly accessible the Fed is today? And you're smiling for a reason. So I know you wrote the book Fed Up. And I look at this thing and it's a comment I've had in the past saying, just because we always had it doesn't mean we always need it. And I'm not trying to say that we should or should not. I just want to hear somebody who has an insider perspective on it. Like, do we need a Fed? And if not, what would that world look like? How would it operate in the typical way of what we have become accustomed to in terms of the Fed saying to the banks, hey, we need you to lend more money. Now our rate is going to be 1% instead of 3%, et cetera.
So I think we're missing the forest for the trees here. 120 years ago, we didn't have a Fed, but we did have a man. His name was J.P. Morgan. So every time there was a financial crisis, he stepped in and he was able to corral all the bankers into his home, literally, and resolve the crisis. He was getting a little old around 1907 with the financial crisis of 1907. And he said, look, we're going to have another panic one day, and I'm not going to be here. So at last check, we're no longer a banana republic. We're no longer an emerging economy. We're a developed economy. And it's high time that, like the Bank of England, we have our own central bank, just in case I'm dead and we have a panic. And because a panic can, of course, take down a financial system, right? Contagion. Think of systemic risk. Yeah. All right. So fast forward 120 years to today. Now, let's take away that lender of last resort. Let's have a bank run. Let's have a Silicon Valley bank spark a full mass contagion nationwide. Now, there's nobody looking over the financial system. So it's completely unguarded. Mm. And this contagion takes effect. And we say to ourselves, thank God there's no China. Because if there was, a moment of vulnerability like this would have them take our entire financial system down. And the entire country would slide into a greater depression that made the Great Depression look like a walk in the park. But thank God there's no China. If there was China, there might have been a public enemy number one stealing our intellectual property all these years. But as long as there's not that, we're cool. We can have our financial system completely unguarded because as a sovereign, we have no enemies at all. And we can leave ourselves open and vulnerable. The Federal Reserve was formed first and foremost to be a lender of last resort in times of financial panic to safeguard the sovereignty of the United States of America. Has it run astray? Look, I'm like a walking, talking poster for ADHD, okay? I don't have 2.5 years of patience here. I'm hyperactive clinically. They wanted to put me at 3.5 years old on the first generation of Ritalin, whatever that was called. My mother was like, give her more work. I've been doing that ever since. So for me to sit down for 2.5 years and write a book, I had to be really pissed off. But the last chapter of the book entails tearing the Federal Reserve down to the studs, removing 90% of what it is today, leaving that 10% that protects our country, and then rebuilding it from the ground up, populated by people who, I don't know, let's just say for starters, are people who are on the receiving end of not being able to hire good employees because monetary policy affects people on planet Earth and should not be therefore made by 786 PhDs who've never set foot out of their ivory tower and have no idea what that flip they're doing.
So would you consider yourself passionate about this or no?
It does tend to raise the blood pressure, but it's important because we don't exist on an island. We do have enemies. And it's not that, look, if Xi Jinping had enough money to take us down by now, Taiwan would have long since been invaded. I'm not a de-dollarization up in the middle of the night tinfoil hatter by any stretch. If there was an alternative to the dollar, then 87% of a $7 trillion per day trading volume currency market would not be in greenbacks. And Saudi Arabia's most recent sovereign debt offering would not have been in dollars. So let me know when those realities on the ground change. It's not that I'm worried about Xi Jinping taking over the dollar. He doesn't want it. Too big of a responsibility. That doesn't mean that we're invulnerable, nor should we behave as such. Given what we know, other countries would rather have happen to this profligate nation that spends beyond its means, thinking that it can do so forever because it's been facilitated and monetized by a deeply corrupted Federal Reserve that needs to be reformed.
So I want everybody to hear this because something I talk about when I talk about income taxes. I'm, libertarian. And I always when people say, "Oh, that'll never happen." I say, "Listen, the first income tax ever was 7% on every dollar above what would today be $11 million bucks, and now we're at 40% on every dollar above $500,000." So I'm like, so the same thing you're saying. The Federal Reserve was started with this last resort. This is here to save everything. And now it's literally a week to week. What's the Fed going to do to make sure that we stave off, AKA kick the can down the road just a little bit further until there's a point when, at the end of the day, when we borrow money, we take away from the future. So at some point, that future is going to be, I don't want to be this alarmist like you say. I don't want to be that and say the future is done. But at some point, I don't want everybody to think that this world we've grown up with is this rosy, cheeky one forever. At some point, there has to be a point where the money does the money does matter. The printing does matter. When does that happen? I don't know. Yeah.
Look, just because, and this was, this was my old boss, Richard Fisher. This was his favorite saying. Just because you're the most attractive horse in a glue factory does not change where you're standing, and that's a fact of life. You're in a damn glue factory. So at some point it will matter. It never mattered to British pound sterling until it did. So there are falls of regimes. They happen.
I want to transition to the banking system because you did speak about it briefly. Something that we've made multiple videos about is contagion over. Contrary to popular belief that you hear in the mainstream, that topic is gone. Since Silicon Valley Bank and PacWest, it's gone. Is contagion over?
Oh, well, that was a Freudian slip on your part, wasn't it? Because you said PacWest, and then you stopped saying it. Because the next domino to fall after First Republic, according to pricing in the market, insurance pricing was PacWest. And it did, but it was beautifully framed. It's as if the FDIC has brought in somebody from the old school Madison Avenue to frame it as PacWest being the acquirer.
I know.
That really wasn't the case, but we did indeed, as if watching slow motion video, see PacWest fall. Mm-hmm. And there was also a very small, itty bitty, teeny weeny, $139 million bank in Kansas that also failed. And the FDIC has not told us why it failed, but the FDIC took a loss on 39% of the bank's assets. Wow. That is probably the first of many community banks that simply have more than this interest rate differential between the risk-free assets they may hold in portfolio, treasuries, mortgage-backed securities, where they hold them and where they're trading today because interest rates have risen so much. That chapter's still open. It's still live. It's still valid. There are still losses sitting there attached to that. But we've now opened a separate chapter at the same time called credit. So the collateral underlying these loans, now that matters as well because more and more. 6 weeks ago, there was only one jingle mail per week or so. There was only one big commercial real estate deal that was blowing up on a weekly basis. Now we're seeing them come daily. And that means that there's been an acceleration of some of the recognition of how poorly valued the collateral backing loans on bank balance sheets really is. And that's your next step. And that's why, even though, as my buddy Jim Bianco says, we've moved, it's not what you would call a bank run. What we've moved onto is a bank power walk. And so I think we will watch the dominoes continue to fall, but not in a contagious fashion, more steadily, which is why when Jay Powell was at the podium after the most recent Federal Open Market Committee and statement release, he basically said, I've seen the senior loan officer survey. It's really ugly. I've moved on. Next question, please. He knows that credit standards are tightening, and he knows that this process is underway, and he's not going to rescue commercial real estate. I just lost about 1,000 followers on Twitter. Sorry, I know. He rescues everything. He bails out everything. It's QE. Whatever, blow me. But he's not going to rescue commercial real estate. It ain't happening. And he's going to let this controlled demolition continue, just like he's going to continue to allow one company after another to file for Chapter 11 at the fastest pace since 2009. As long as there aren't there isn't contagion in the banking system, as long as there isn't contagion in the bankruptcy cycle, in the credit market, you're not waking up one day and saying, you know what, I want to sell my HYG today. And you being told, nope, sorry, redemptions are closed until further notice. As long as there's nothing systemic in nature going on and the markets continue to function, this will continue to go on. But again, last September, 0 states with rising continuing jobless claimants. Today, 46.
Yeah. Is it possible? I mean, we're one of the few places in the world, if not the only place in the world, with thousands and thousands of banks, not consolidated into 10, 15. Is that a realistic possibility that it gets to the point where the Fed says, you know what, this is too widespread. We don't have to worry about contagion, for lack of a better word. Let's consolidate everybody into, call it the big 15, and we go from there.
And do you like that or dislike that?
I'm not going backwards in time and renaming it. It's a crappy life. It's a wonderful life and part of the fabric of the U.S. economy, and will always be the fabric of the U.S. economy as long as I have a say in the matter, is the backbone of the community banking system. It's a banker knowing you and your family for generations plural, and that your credit good based on a handshake, knowing that you're going to pay the money back, or that somebody who knows you in the community is going to make sure that you remain in good standing. There's no reason that we should take upon ourselves some Chinese type of structure of just having a handful of really powerful banks. Because where's that gotten us today? Having an effective oligopoly of the largest banks. Really, it's given us an inefficient system, and we've also had a great, huge, massive proportion move into the private banking sector that's completely unregulated.
Mm-hmm. Do you think it's possible it goes in that direction, though, even though all three of us don't like it?
I happen to think that, and color me idealistic, which I haven't been since I was like in my teens. So I happen to think that I think your average American would not cry if there were more PacWests, and I don't mean to be picking on PacWest in particular. Excuse me. If there were more regional banks that became super regional banks, I don't think your average American would bemoan that or even attempt to stop that. But I think a lot of communities that have lost their franchised auto dealerships, so now they have to drive to town to get a car repair because one of the big three took their dealership down. And Walmart took down their hardware store and their local grocery store. I think a lot of, and I spend a lot of time in Indiana and in smaller communities in the United States. My kids happen to go to a military academy in a very small town in Indiana. But you speak to a lot of regular Americans, and I think that they're going to draw the line at having Big Brother put upon you the fact that you no longer have any attachment to your community. We're going to take away the last standing support of your community bank. I think that you could see more It's a Wonderful Life type of episodes where communities gather around. Now this will not, are we going to lose some, at least that potentially thousands plural of banks? Yes, that could happen. And that would be a tragedy. But I think that you will not see a full-blown consolidation that Janet Yellen accidentally envisioned on an open mic in front of Congress to an Oklahoma congressperson who was none too amused that she was like, oh, we have different rules for those little people. Mm-hmm.
You say it's a tragedy. I don't know. It's, we have several businesses. We have a big real estate portfolio. It's interesting about real estate. We just made an offer on a big portfolio here in Ohio, and it was amazing because it was the first time in a very, very long time that the guidance from the broker decreased from the first call to the next call a month later. And you hear Warren Buffett and Charlie Munger talking about the banks that they follow and the number of bad loans out there. And you saw what happened in San Francisco with and New York City, and how many buildings are underwater, which has a lot to do with the fact of occupancy for offices and things like that. Can you provide some more light on that one in terms of the commercial real estate and what you have seen in terms of the data behind how bad the loans really are in commercial real estate?
I mean, the most aggressive estimate that I've seen is somewhere around 40% in terms of loss.
Or underwater.
Yes. And again, but that's the most aggressive. the reason I hesitate to put a number on it is because all of my buddies who are in the trenches in commercial real estate are indeed seeing pricing move violently, as you just demonstrated, from 1 month to another. In other words, it's a fast moving value. TREP, they're great people, they can't keep up with how quickly delinquencies are rising. And by the way, it's not just office. Look what's happening with lodging. To say nothing of retail, as we see 5,000 layoffs at CVS. It's easy to foresee, right, that we've got too many Rite Aid, CVS's, and Walgreens, the same way we used to have too many Office Depots, Office Maxes, and Staples. Mm-hmm. So the stories haven't been told, and it has nothing to, it's not isolated purely to office. But my buddies in the trenches tell me the biggest impediment right now is that it's trading if it's trash. Actually, it's being given back if it's trash, and it's trading if it's trophy. But it's either trash or trophy, and nothing in between. Everything in between is this cohort, 90% of whom say, we're just going to hold on until we get back to the zero bound. Powell's going to have to pivot. It will have to happen. We will not have price discovery for 90% of the market. We will be able to hold on. Unfortunately, with commercial real estate, unlike, say, high-yield corporate debt, the maturity wall is now. Yeah. And the extent to which you can extend and pretend means somebody's going to lose something, because it's not extending and pretending as a zero-sum game. Now it's extending and pretending, and somebody's paying a price for that. And that's the game changer. And that's the reason you saw PacWest go. And that's the reason you will see slow demolition in commercial banking, because nobody's going to be able to stop commercial real estate if the Fed doesn't come out with a full-blown and regulators have come out and said, do what you can for commercial real estate, please. Mm-hmm. It was kind of extraordinary a few weeks ago. And they came out 2 days ago and they said, look, that whole discount window, let's destigmatize it however we can. There wouldn't be these panicked advisories coming out of major regulators in Washington, D.C. if they didn't have regulators that were looking at the books going, oh, good God, there's no rectifying this. So let's do what we can at a regulatory level to try and mitigate the damage on a day-to-day basis so that we can try and, as they did in the aftermath of the savings and loan crisis, just come to a certain number. We're going to close this many banks on any given day, but it's going to be measured.
I obviously think that the government will be there to help everybody out when necessary, because
they clearly came to the rescue very quickly several months ago.
They always do. They just always decide to come to the rescue, and it's just always.
And it was really gross. I mean, it was really, really gross.
I don't like it for a couple of reasons. One of which is I'm a value investor, so I need worse times to do better. I haven't bought much real estate in the last 5 years, and this is a big portfolio that I'm even. When we first came up with our numbers, and I looked at it, I said, how are we this close? Because I was so shocked that we were even this close on the number, because before it was literally calls with brokers where, here's our price. Shoot, we're 20% below. Don't even waste your time. Now all of a sudden it was, hey, we're within 10%. Oh my God, how are we within 10%? What is going on here? And again, I'm not a doomsdayer. I'm not sitting there saying the world has to end. All I'm sitting there saying is, I believe in cycles, and a cycle has to happen. And I look at the 2008 financial crisis. I made a ton of money in real estate doing back then. But still the government bailed everybody out. They bailed a lot of people out.
That cycle was cut short. I mean, if you think about the current cycle,
right.
Even though there are very few transactions, the current cycle is lasting longer than that did, because Jay Powell has done this crazy ass thing called higher for longer. Nobody thought that he would have held the line for as long as he has. Last January of 2022, when he was like, the gauntlet's coming down, people, nobody envisioned that in July of 2023, August of 2023, that this discussion would be had, that he still has not pivoted. It didn't enter 99% of anybody's minds.
Yeah, and I will give him credit till I'm blue in the face about that, and say, hey, because he's like, I watch him on the Senate floor and the House floor, and they just look at him and saying, you're ruining America. And he says, okay. I mean, he just basically says, all right, sounds good. Do you need to go?
Yes.
Okay.
So,
well, Danielle, thank you so much for taking the time to come on Everything Money. We really appreciate it. We're very happy to have you here today, and you're welcome back anytime.
Well, guys, I feel like it went by in 5 minutes, so clearly we need to do this again. And shameless plug, DiMartinoBooth.substack.com. So as forthright as I speak. I write that same way we publish every day. Gentlemen, I thank you so much for your time.
Thank you. And we're going to put a link at our link below to sign up for a Substack and check out her books on Amazon, guys.
So guys, I hope you enjoyed that interview. Please go and get Danielle's book. You will not regret this read. It is a fantastic read. You can get it on Amazon or you can get it anywhere books are sold. And also go to her Substack, subscribe to it, DiMartinoBooth.substack.com. You guys have a great day.